Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
We've got some important updates in the financial sector to discuss. First up, Swana Securities has surrendered its MBFC license and reported a lower profit this quarter. Then we have a positive story from Bank of Maharashtra, whose fiscal year 26 profit jumped 27.17%, with business topping Rs 6,42,531 crores. We also have Vertis Infrastructure Trust redeeming Rs 700 crores in commercial papers, Indian state-owned enterprises planning overseas borrowings up to $15 billion, and the Reserve Bank of India maintaining the repo rate at 5.25%, while introducing measures expected to attract significant foreign capital inflows.
That's right, Vijendra. Swarna Securities has surrendered its non-banking financial company license, stopping all lending by March 31, 2026. Their total income rose slightly to 1.44 crores rupees, but profit after tax fell sharply to 0.62 crores rupees. They now plan to enter real estate and infrastructure, sectors with high execution risk due to their inexperience. No dividend has been recommended for fiscal year 26, and revenue will now depend largely on lease rentals and dividends. Investors should closely monitor their annual general meeting on June 30, 2026, for updates on loan recoveries and progress in the new business strategy.
Turning to banking, Bank of Maharashtra reported a strong performance. Net profit jumped 27.17% to Rs 7,019 crores in fiscal year 25 to 26, driven by a 17.47% increase in total business to Rs 6,42,531 crores. Gross non-performing assets declined to 1.45%. Net NPAs dropped to 0.13%. And the Basel III capital adequacy ratio stood at 18.36%.
That profit growth reflects strong operational efficiency. CASA deposits increased 12.48%, gross advances rose 21.74%, and digital adoption continued to strengthen. Mobile banking transactions increased 36%, while more than 46,000 savings accounts were opened through video KYC. The combination of asset quality improvement, healthy capital buffers, lending growth, and digital expansion positions the bank well for future growth and strengthens investor confidence.
Let's move to infrastructure finance. Vertis Infrastructure Trust has fully redeemed commercial papers, totaling Rs 700 crores on June 5, 2026, covering 14,000 papers with no outstanding amounts. The redemption was managed by Vertis Fund Advisors Private Limited, with Axis Trustee Services, Catalyst Trusteeship, and ICICI Bank supporting the process.
This timely redemption aligns with Securities and Exchange Board of India regulations and reinforces investor confidence. Public disclosure enhances transparency and demonstrates strong governance standards. Similar discipline was seen with Repco Home Finance, which redeemed commercial papers worth 100 crores on June 5, 2026, and Arman Financial Services, which paid Rs 2 crores and 14 lakhs and 56,000 in quarterly interest on its 75 crore rupee NCD issue. Such actions strengthen market confidence in debt issuers and support future borrowing activities.
Moving to global funding developments, Indian state-owned enterprises plan overseas borrowings of up to $15 billion in fiscal year 26 to 27, benefiting from a 3% funding cost advantage under the Reserve Bank of India's concessional swap facility. Public sector entities such as Power Finance Corporation and Indian Oil Corporation have already raised nearly $5 billion in fiscal year 26.
This is significant because it reverses the previous decline in external commercial borrowing flows. The facility reduces domestic borrowing pressure and improves visibility for Indian issuers in international markets. Additionally, the Reserve Bank plans to absorb at least half of hedging costs, currently between 3.5 and 4%, for public sector undertakings borrowing overseas. Major beneficiaries could include Rural Electrification Corporation, Power Finance Corporation, and Power Grid Corporation, making foreign funding increasingly attractive.
The Reserve Bank of India maintained the repo rate at 5.25%, while raising inflation forecasts to 5.1% and lowering growth expectations to 6.6%. Alongside this, the RBI introduced measures to attract around $50 billion in foreign capital through expanded access for non-resident Indians, concessional swap facilities, and broader investment opportunities for foreign investors.
These measures are designed to support the rupee and strengthen the bond market. The government also removed capital gains and withholding taxes on certain government bonds for foreign investors and expanded access to 15-year, 30-year, and 40-year securities under the fully accessible route. Combined with possible inclusion in major global bond indices, these reforms could bring substantial foreign inflows, lower borrowing costs, and improve India's external position while supporting the domestic debt market.
The bond market responded positively. Benchmark government bond yields eased, overnight index swap rates declined, and market participants interpreted the RBI's actions as supportive for fixed income assets. However, geopolitical risks and rising crude oil prices remain major concerns.
Exactly. Fund managers now favor high-rated corporate bonds with maturities between 2 and 4 years, offering spreads of 100 to 120 basis points over government securities and yields near 7.5 to 7.7%. While rising oil prices and global uncertainty may limit gains, tax reforms, expanded foreign participation, and lower hedging costs have improved the outlook for both government and corporate debt markets.
The Indian rupee also strengthened significantly, gaining 0.9% and closing near 94.945 per US dollar, its strongest daily performance in months. RBI measures including discounted forex swaps, support for external commercial borrowings, and extended foreign currency deposit facilities contributed to the rally.
Those initiatives are expected to attract between 25 and 35 billion US dollars in inflows. State Bank of India estimates that foreign currency non-resident deposits alone could contribute more than 34 billion US dollars. Despite concerns around oil prices, US-Iran tensions, and global inflation, these policies have improved sentiment and strengthened confidence in India's currency and debt markets.
Gold markets moved in the opposite direction. Gold prices fell to approximately $4,321 per ounce after stronger US employment data increased expectations of future Federal Reserve tightening. Meanwhile, China's central bank increased gold reserves for the 19th consecutive month.
Rising oil prices and inflation concerns continue to influence precious metals. Although gold prices declined, speculative investors increased net long positions by more than 14,000 contracts, indicating confidence in a longer-term rebound. Indian demand, however, remains relatively weak due to price volatility and uncertainty regarding future global monetary policy.
Before we wrap up this segment, regulatory enforcement remains a major focus. The Reserve Bank of India fined Canara Bank Rs 41.8 lakhs for KYC-related deficiencies and imposed penalties on other entities for compliance violations. At the same time, foreign portfolio investor rules have been relaxed, concentration limits have been removed under the general route, and broader reforms are being implemented to attract foreign investment into India's debt markets.
These developments highlight two parallel trends. On one side, regulators are enforcing stricter compliance standards, emphasizing transparency, KYC discipline, and governance. On the other side, they are making Indian debt markets more accessible to global investors through tax incentives, expanded market access, and regulatory simplification. Together, these measures strengthen confidence in India's financial system and support long-term growth across banking, debt, and capital markets.
Let's move to the infrastructure and REIT space. Cube Highways Trust plans to go public by filing a draft offer document with the Securities and Exchange Board of India. The trust aims to raise Rs 5,000 crores through an offer for sale, while acquiring additional assets through an equity swap. Its portfolio includes 27 special-purpose vehicles, with assets worth more than Rs 36,842 crores and a cost of debt of 7.53% per annum.
This proposed listing could significantly increase liquidity and broaden the investor base. The equity swap structure may diversify revenue streams and improve operating scale. Investors generally welcome the additional transparency and governance standards associated with publicly traded infrastructure investment trusts. However, regulatory approvals remain important, and any delays could affect the timeline and growth plans.
In corporate fundraising, Supra Pacific Financial Services plans to raise Rs 20 crores through secured, unrated, and unlisted non-convertible debentures. The company will issue 2 lakh units through private placement, offering tenures ranging from 1 year and 1 month to 5 years and 10 months, with coupon rates between 11% and 12.6%.
While the issue offers attractive yields, investors should remember that these securities are both unrated and unlisted. That limits liquidity and increases risk compared with publicly traded instruments. The success of this fundraising effort will depend heavily on investor confidence in the company's cash flows and its ability to manage the higher cost of capital.
Credit rating activity also remained active. Informatics downgraded Sri Tirupati Balaji Agro Trading's bank facilities of Rs 104 crores to investment grade BBB+ with a stable outlook. Although the outlook improved from negative to stable, the downgrade reflects weaker financial performance.
The stable outlook suggests that credit conditions may not deteriorate further in the near term, but the downgrade could increase borrowing costs and lead to greater lender scrutiny. At the same time, CRISIL reaffirmed Shoppers Stop Limited's long-term rating at A+ with a stable outlook and maintained strong ratings for global SS beauty brands. These contrasting actions highlight how investors continue to differentiate carefully between issuers based on financial strength and execution capability.
The REIT market saw another important development. Embassy Office Parks REIT decided not to redeem its Series 5B non-convertible debentures, worth Rs 11,000 crores before maturity. Instead, the REIT will allow the securities to continue until the scheduled maturity date.
This decision suggests a deliberate capital management strategy. By maintaining the debt rather than calling it early, the REIT preserves financial flexibility and signals confidence in its ability to manage future obligations. Investors often interpret such decisions as an indication of comfort with liquidity and cash flow conditions.
Turning to international capital flows, India continues its push for inclusion in major global bond indices. The government has removed certain tax barriers and expanded foreign investor access to long-dated government securities, including 15-year, 30-year, and 40-year bonds, as well as sovereign green bonds.
These reforms directly address concerns raised by global investors regarding taxation, settlement infrastructure, and market accessibility. Successful inclusion in the Bloomberg Global Aggregate Index could attract billions of dollars in fresh capital, deepen liquidity in the bond market, and help lower borrowing costs across the economy.
Another major policy initiative is the proposed variable capital company framework for GIFT City. The structure would allow multiple investment funds to operate under a single umbrella while maintaining separate assets and liabilities for each sub-fund.
That's a significant step. Variable capital companies are already widely used in global financial centers such as Singapore and Luxembourg. Introducing a similar framework in GIFT City could improve investor protection, reduce cross-liability risks, and attract larger pools of international private equity and venture capital investment into India. The Reserve Bank of India also continued efforts to strengthen the country's external position. Foreign currency non-resident deposits with 3 to 5 year tenures will receive substantial support, while hedging benefits and swap facilities are expected to encourage additional inflows. Analysts estimate that these initiatives could bring between 30 billion and 40 billion US dollars into the country. Combined with tax incentives for bond investors and easier access to government securities, the measures create a comprehensive strategy for attracting long-term foreign capital and supporting the rupee.
Regulatory oversight remained in focus as the Reserve Bank prepared an updated list of upper-layer non-banking financial companies. Tata Sons has applied to deregister as an upper-layer NBFC, a move that could alter future compliance requirements.
The industry is watching closely because upper-layer classification brings additional regulatory obligations. Until the revised list is released, companies must continue operating under existing requirements. Any changes could influence reporting standards, governance practices, and overall market supervision.
Finally, one of the most significant investigations currently underway involves an alleged fraud of Rs 661 crores connected to Haryana government funds. The Central Bureau of Investigation alleges that funds moved through multiple entities including private banks and intermediary companies.
The case highlights the importance of strong controls, transparency, and oversight in public fund management. Investigators have alleged a coordinated conspiracy involving public officials and private entities. Beyond the immediate legal implications, the case may encourage tighter compliance standards and stronger monitoring of government-related financial transactions across the country.
Let's turn to capital markets and fundraising activity. Edelweiss Financial Services Limited launched a secured redeemable non-convertible debenture issue of Rs 300 crores, offering 10 series with maturities ranging from 2 years to 10 years and yields between 8.64% and 10%. At least 75% of the proceeds are intended for repayment of existing borrowings, while the remainder will support general corporate purposes.
The structure offers flexibility through annual, monthly, and cumulative payment options. With a CRISIL A+ stable rating and listing on BSE Limited, the issue is positioned to attract investors looking for relatively secure fixed income opportunities while maintaining liquidity through exchange trading.
Another trend worth noting is the changing behavior of foreign portfolio investors. Since the beginning of fiscal year 25, investors have withdrawn approximately Rs 44.6 billion from Indian equities, while simultaneously investing roughly Rs 19.3 billion into debt instruments.
That shift reflects a preference for stability amid market uncertainty. Debt markets have become increasingly attractive because of global bond index inclusion, tax reforms, and improved access mechanisms. Historically, debt inflows have represented a substantial share of overall foreign portfolio investment into India, and current trends suggest that international investors continue to view Indian fixed income assets favorably.
Let's move to insurance and long-term investing. Life Insurance Corporation is working with regulators to develop investment instruments capable of matching liabilities that can extend for as long as 50 years. The objective is to better align assets with long-duration annuity commitments while continuing to support infrastructure financing.
That's an important development for India's long-term capital markets. LIC also aims to maintain a value of new business margin above 20% while exploring fintech partnerships to improve efficiency and digital capabilities. Such initiatives could strengthen returns for policyholders while enhancing operational competitiveness.
The foreign exchange picture also improved. India's reserves increased to more than 682 billion US dollars, reversing a sharp decline from the previous week. Foreign currency assets rose significantly, while gold reserves experienced a modest reduction.
The increase reflects a combination of Reserve Bank interventions, currency movements, and active reserve management. Maintaining a strong reserve position is especially important given ongoing geopolitical tensions, fluctuating oil prices, and global economic uncertainty. It provides an additional layer of confidence for investors and policymakers alike.
Debt servicing discipline remained a recurring theme across the market. Aadhar Housing Finance, Saman Capital, Arman Financial Services, Repco Home Finance, Steel Exchange India, and several other issuers completed interest or principal payments on schedule and in some cases ahead of schedule.
Timely payments are critical because they reinforce confidence among investors, rating agencies, and lenders. Whether it involves commercial paper redemptions, quarterly interest payments, or annual coupon obligations, consistent servicing of debt obligations contributes directly to market credibility and lowers refinancing risk.
Let's revisit the broader debt market. Corporate bonds with maturities of 2 to 4 years continue to attract attention, particularly because they offer spreads of roughly 100 to 120 basis points over comparable government securities. At the same time, tax incentives and broader foreign participation have improved the outlook for longer duration government bonds.
Investors are increasingly balancing accrual strategies with selective duration exposure. While short and medium-term corporate bonds provide attractive yields, long-duration government securities may benefit from foreign inflows, spread compression, and potential capital gains if market conditions remain supportive.
In the Real Estate Investment Trust segment, Bagmain Prime Office Real Estate Investment Trust received a final AAA stable rating from CARE Ratings. The rating followed key operational milestones and reflects the highest level of credit quality within the rating framework.
A AAA stable rating provides strong reassurance regarding the REIT's financial strength and ability to meet obligations. However, continued surveillance remains important because future ratings will depend on performance, disclosure standards, and execution of business plans after listing.
Across all these developments, a common theme emerges. The Reserve Bank of India continues to pursue a balanced approach, maintaining the repo rate at 5.25%, supporting foreign capital inflows, encouraging overseas borrowing where appropriate, strengthening the rupee, and promoting deeper debt markets.
At the same time, the government has complemented those efforts through tax reforms, expanded foreign investor access, support for global bond index inclusion, and initiatives such as the Variable Capital Company Framework for Gift City. Together, these measures are helping position India as an increasingly important destination for global fixed income capital.
As we conclude today's edition of the DebtCircle podcast, we've covered a wide range of developments, from Swana Securities' strategic transition and Bank of Maharashtra's strong earnings growth, to infrastructure trust activity, overseas borrowing plans, bond market reforms, rupee appreciation, foreign investment measures, REIT developments, debt issuances, reserve growth, and regulatory actions across the financial sector.
And the overarching message is clear. India's financial system continues to evolve through stronger regulation, deeper capital markets, improving foreign investor participation, disciplined debt servicing, and expanding funding opportunities across banking, infrastructure, insurance, and corporate finance. We'll continue tracking these developments closely and bringing you the most important updates shaping the debt and fixed income landscape.
Thank you for joining us on the DebtCircle Key Roundup podcast.